Rivian stock versus Lucid stock. So if you're somebody that's invested in Rivian stock or Lucid stock, you'll want to watch this because during this Rivian versus Lucid comparison, we're going to present some interesting facts about both these companies that certainly make them a lot less appealing than when we first looked at them. And we've researched electric vehicles extensively over the years and written pieces about these firms. I'll put links to those in the description of this video. But let's start by putting this into context. Why do you want to invest in electric vehicles? It's important to take a step back, not just look at a stock that maybe has some price action, but say, why do I want to be invested in this theme? Well, it's probably because you expect EVs to grow and displace gas-powered ones. But that can be tricky because if you spend time in the emerging markets found throughout this world, you realize that, sure, electric vehicles are seeing some success in developed markets, but there's 194 countries out there that each one will present challenges. And ultimately, electric vehicles need to see a lower total cost of ownership without subsidies. So these are things that you need to consider. Also consider what geographies you're most bullish on. So this past year we spent time in China looking at electric vehicles there and the success stories that they're having, one being BYD. Think about what types of vehicles you'll see the most growth in. Proterra, for example, they produce electric buses. They also went bankrupt, and that's fairly common in the electric vehicle world because it's a lot more difficult to produce electric vehicles at scale for a profit than one might think. And that's why what Tesla did was so remarkable, and people make the mistake of looking for the next Tesla. Well, if you're looking for the next Tesla, just invest in Tesla. So let's be frank. When you look at a company like Rivian or Lucid, you see the success Tesla had. You think other companies can replicate that, and these happen to be two of the most popular EV stocks, but ultimately you're betting on the underdog. And when we invest in a theme, we always invest in leaders. That's why this piece we wrote is Searching for the Next Tesla Pointless, looks at that thesis of always investing in leaders. So this piece is going to really look at which of these underdogs is the best bet. Now, when you look at this table, what do you see? Well, the optimist might see that Rivian sold $1.6 billion worth of vehicles in the past trailing 12 months. Last quarter, Rivian saw over $1 billion in vehicle sales. They're seeing tremendous sales growth. But the most important takeaway here is that Rivian is selling vehicles for less than what they cost to produce. So look at this slide here and see if you can spot the difference. Both Rivian on top and Lucid on the bottom are indeed producing vehicles for more than they can sell them for. And that's not a business, right? You can't produce a product that costs more than what you can sell it for. Well, the argument is that once they scale, then they'll eventually get there. But see if you can spot the difference between these two. It's the trend, all right? So on the top, you see Rivian going from a gross loss of $700 million, $900 million, $1 billion, $500 million, $400 million. That's moving, trending downwards. Now look at Lucid. 195 million, 297, 357, 351, 404. That's moving in the wrong direction. So that's a big concern for Lucid, especially when you consider how expensive their vehicles are. And when you're operating with a negative gross margin, it's very difficult to cut the price of your vehicles, isn't it? Because then you need to make that up for scale, especially when people don't want them. And we'll talk a little bit more about that later. Now, one thing people often say is, what about Tesla? Yeah, what about Tesla? Love pulling up this chart here, this table from their earliest filing with the SEC, and you can see how Tesla, even in its earliest years, had a positive gross profit. Elon Musk believes that Tesla's biggest advantage is their manufacturing capabilities, and nobody can touch those. That is huge, and these firms are having to compete with a company that absolutely dominates when it comes to manufacturing capability. So I want to pause this for a second and just let you know that we don't run ads on this channel, and that means our growth suffers. So if you're new to this channel, please just subscribe, become a subscriber. It's that simple. I personally believe that you can't sell somebody something unless you show them value first. So watch our videos for a while and see if you think we add value to your investing process. If you're a paid subscriber, somebody who's paying us money, thanks from the bottom of my heart. You're making these videos possible. If you're a regular viewer and you're considering a paid subscription, it's a good idea. So we're offering 20% off Nanalyze Annual with this coupon code YouTube20. I don't spend all my time making videos. Most of my time goes into things like providing value for paying subscribers in the form of trade alerts, our Discord server where we have a community that talks about our investments, the premium newsletter we put out, webinars, our 460 tech stock catalog, our own 35 tech stock portfolio, 20 stocks that we've found most compelling that we would consider subscribers should probably buy now if they're looking for dividend growth investing stocks and tech stocks, 2,300 research pieces, and of course our bonus dividend growth investing report. That all comes with a Nanalyze subscription. Just go to the payout page here, click Have a Coupon, put in YouTube 20, become a better investor for less than $17 a month. So let's get back to this video. Rivian and Lucid just can't grow fast enough to make anyone happy is this title of a piece by Jalopnik, I believe, and it says that the EV startups, and they refer to them startups, so we wouldn't. These are publicly traded companies, were supposed to erode Tesla's dominance overnight, but are expected to underperform quarterly delivery estimates again. And the word on the street is that Rivian can't build trucks and SUVs fast enough, and the comment here is that their product is a bit too complex and over-engineered for volume production. That's according to consultancy firm Munro and Associates that everybody seems to venerate. Then, regarding Lucid, they say that it's solved production, but can't find enough people to buy what it makes. And they say that the Air is unquestionably a beautiful sedan, but it's just that, a sedan, and probably also one too expensive for its own good. Couldn't agree more. Look at the prices for these sedans. Top of the line range, $250,000. You have Americans now, they're at a record high for delinquencies on auto payments and credit card payments. You really think they're going to be going out in this high interest rates that we have now and purchasing these vehicles where the base price is $82,000? Probably not. Now, when you look at Rivian and Lucid, what you need to ask yourself is one question, and it's something they teach you in B school. What's the one thing every business needs to do? And the answer is they need to survive. So let's look at that. For Rivian, here's a look at operating cash flow. So this is the amount of massive amounts of cash that firms like this need to burn up as they try to get to that point where they can achieve a positive gross profit, not to mention all the other expenses that come after just the cost of goods sold. So if we assume a $1.3 billion cash burn rate each quarter, and that's based on historical numbers that you see here, then Rivian has about 7 quarters before they run out of cash. Now, raising money in today's environment, that's not going to be pretty. This is a firm that already has $3.3 billion in debt. They'll need to raise more debt or sell shares. And you can see along the bottom there, see how their share count is expanding every quarter? They're already issuing out shares, and they're going to have to issue out a whole lot more, and that's going to bring the price of their shares down, even make them even more depressed. And we'll talk a little bit about valuation, but ultimately, you need to pay attention to that burn rate, and of course, for Lucid as well, the burn rate. So Lucid has $5.25 billion in cash and cash equivalents. And we can say, well, if we assume $700 million in cash they're burning each quarter, then they also have about 7 to 8 quarters before running out of cash, and they have $2 billion in debt. Look at shares issued increasing over the bottom there on a quarterly basis. So 2 things, pay very close attention. Gross margin, you want to see that go to a positive as quick as possible. That's the basics of running a business. And you want to make sure that they have enough cash to keep scaling so that they can get there. Now let's talk about valuation. Lucid, I double-checked these numbers. So we use what's called a simple valuation ratio. We did a video on this. It's on YouTube and also on our website. It's a great piece, and it looks at historical simple valuation ratio, how it differs from price to sales and things like that. But when we calculate that for Tesla, we can use that as a benchmark, right? The leading company for electric vehicles has a simple valuation ratio of 8. We simply took their market cap, divided it by annualized revenues, which is last quarter times 4. Calculate the same for Rivian. That's in range, all right? So it would be acceptable to believe that these two up-and-comers shouldn't command a higher valuation than perhaps the most successful vehicle manufacturer ever. So when you look at Lucid and you see a simple valuation ratio of 23, what we can then do is just back that out and say that if they had the same valuation as Tesla, which is reasonable to think that it shouldn't be higher than that, their price would be about $2.12 a share based on $6 a share today. And also consider dilution when you evaluate. We do these sorts of comparisons. Now, another thing that really turns us off is when we look at the SPAC decks for both these firms. And we've said before, broken promises, and critics say, well, they didn't make promises. Well, they put together these decks and sold shares based on assumptions and dreams that they were selling retail investors. And as we warned, SPACs were a horrible idea. We've covered 99 of them, and all of them, I think, but 3 are avoids and have done horrible over the years. That's because there was no institutional vetting process in place, which is what we pointed out. When you look at Rivian here, just these numbers are embarrassing. Whoever put these together, if they're still employed with the company, should be absolutely embarrassed. Gross profit in 2023 of $70 million. We look at the gross profit for 2022. Let's say 2022 is supposed to have $1 million, and it's minus $3 billion. Just horrible, right? So, in this year, of course, they're not coming any closer to having a positive gross margin. So, what they've promised investors and what they're actually doing are two very different things. Lucid's hot air. So when you look at the revenues, they were supposed to do this year $5.5 billion in revenues. Doesn't seem like that's going to happen. Last year was supposed to be $2.2 billion. They realized $600 million. You look along the bottom here, they expected to have gross profit this year of $1.1 billion. It's unlikely they'll see revenues of over $1 billion. So both these firms may set expectations with investors that they weren't able to meet. And you ask the question, well, which of these companies is most likely to survive? And that's, of course, the answer that you're looking for here if we're looking at Rivian versus Lucid. Seems like Rivian's probably in a better position based on the analysis we've looked at today. So if you're bullish about EVs, it's hard to see why you'd want to invest in either of these firms. Just invest in the leader. Both Rivian and Lucid are surviving, not thriving. Now, key metrics to watch for both firms: progress towards positive gross margins is critically important, and of course, cash burn, runway. We continue to avoid all EV SPACs, as we've said over the years. We like Tesla as a play on EVs and, of course, autonomy. And maybe up next, we'll do a piece on Polestar versus Rivian. So I'm going to put up another video here that you might want to watch. Before you do that, please click the Nanalyze logo on the right. Subscribe to our channel. Thanks so much for taking the time to watch this today.